All right, good afternoon, everybody. Welcome to this panel on financing climate solutions. We're going to get right into it. We do have a great panel for you. I've got a lot of ideas and content to share. We'll do some intros and some framing discussion, but very much want to bring out your perspectives and comments, so we're going to try and get started on that part of the exchange a little bit earlier than we have at other sessions here. So I'm going to take my seat and we'll kick it right off. So thank you for joining us. Very bright light.
It is.
Mm-hmm. All right, thank you again. So this panel is going to explore the issues of climate finance, really in the aggregate, all the ways that we need to raise capital for the suite of climate solutions, obviously emphasizing carbon markets and carbon pricing as drivers for that, but not exclusively, since this is a robust set of strategies, but it sits inside that larger financial ecosystem and the many trillions of dollars that we need to raise over the next several decades. I'm going to get to my colleagues and panelists on the introduction side in just a minute, but my name is Dan Adler. I'm Deputy Director for the State's Infrastructure and Economic Development Bank, Ibank, here in California. We are traditionally a municipal lender, but we're stepping into the space of green banking and building more capacity and addressing more sectors, including the ability to lend to private parties for climate solutions. This is straight up lending. This is green eye shade type stuff, so it doesn't have a lot of the sort of sex appeal and snazz of carbon finance, but we are increasingly seeing infrastructure investments coming our way that have a carbon theme or carbon sub-theme, whether it's trying to underwrite certain portions of the risk of an LCFS transaction, or thinking about biochar-derived carbon credits as a second or third order revenue stream from a straight up power infrastructure play. So obviously these themes converge, and we as public lenders are trying to be catalytic, take risks where we can, but thinking about the strategic application of a public dollar to unlock significant multiples of private capital. That ultimately is the leverage that we need, not just from our policy, but from our public spending as well. So I want to turn to my colleagues for their introductions, and then I'll have a few framing questions and hopefully more of a dialogue. But before we do that, we thought it would be useful to understand, who's in the room, and just kind of a quick show of hands, so we can hopefully understand and anticipate your interests, but also frame our comments accordingly. So let me see a show of hands of you, those of you who would consider yourselves developers in the carbon finance world. Exceptionally bright light. I think I see. Okay, well, a handful. How about investors actually mobilizing capital for climate yourselves? Very good. Folks who are creating platforms, intermediary platforms, technical platforms for carbon transactions. Great. How about credit buyers? Folks who are focused principally on the purchasing of credits for whatever purpose. Okay. And the advisory sort of registry and technical services community? Good. Okay. So I think we've got a pretty wide range of folks in their perspective on this set of questions. So I'm going to hand it over to my colleagues starting immediately to my left, but in the course of their introductions, we had sort of a top-level question that I asked them all to address to kick us off. And that is the nature of the main headwinds and tailwinds in the carbon market specifically right now as they relate to finance, but not exclusively. So main head and tailwinds, and what's changed, good and bad, since the last time we had this gathering, which I understand to be last year, although I was not invited myself. So to my left, let's get started.
Hey everyone, my name is Kevin Townsend. I'm with a company called Anew Climate, and thank you all for being here. I'm glad they chose the large venue for this because it's going to be standing room only. Yeah, you can tell. Anew Climate is a comprehensive climate solutions provider, at least we try to be, and that means that we do advisory, everything from the beginning stages of footprint setting or goal setting, all the way through project development in carbon offsets and renewable fuels and EVs. And other types of climate beneficial projects. And we also we raise and deploy capital. So we're an owner of physical assets as well, and we do that exclusively for climate beneficial projects. So we most recently raised and deployed $1.8 billion in the last 6 months to acquire a very large timber company to fundamentally change how that land has been managed in the past going forward for the benefit of the climate. your first question was, what do I see as the major headwinds and tailwinds?
Yep.
I'm going to flip it on its head. I'm going to talk about the tailwinds first because I'm ever the optimist. So what's going right? What are our big tailwinds? And I would say one of the biggest ones is that when you look at the amount of sheer emissions that are covered under corporate commitments to date, whether that's SBTI or an internally developed climate commitment or anywhere in between, those emissions are just absolutely massive. The goals that are the reductions that are going to be required to hit those goals are just tremendous. They're huge, and they way outstrip the supply of reductions and removals that we have today. And so that's a huge tailwind. And related to that, when the SEC, I'm going to say when instead of if, but I should say if, when the SEC comes out and says, hey, we're going to hold you to those climate commitments that you made in 2030, that's going to be, it's going to make it real. It's going to get real fast, for those CFOs, those corporate sustainability advisors or officers in those companies. And even if the SEC doesn't do that, I think the train has left the station, and that the stakeholders, the communities, the consumers are going to require that anyway. So I think that's the major tailwind that we've got. And the headwind, I would say, the biggest headwind that we've got is just corporate paralysis. And there's this tremendous fear of getting burned for doing the right thing. And it's always been there, but it's very, very pronounced today. And this comes out of a belief, I think it's an errant belief, but it comes out of a belief that you can do something to avoid being criticized. And I actually just don't think that is true. I think if you're transparent enough about what you're doing, someone will accuse you of greenwashing. And if you're opaque enough about it, someone will accuse you of green hushing. And if you set an aggressive goal, you'll be criticized for setting an unrealistic goal that you don't know how to achieve. And if you set a conservative goal, you'll be criticized for it being too easy or not costing you enough. So I think that this corporate paralysis, it needs to be replaced by confidence in what we're doing, and we need officers to stand up and say, hey, we did our homework, we did our diligence, and we're listening, but we're gonna stand up and be proud of the choices that we've made. So I think that's our greatest headwind right now.
And how about changes since the last gathering, the last 12 months?
Changes since the last 12 months. There have been a lot. If you don't know the company name Anew, that name is new as of a year ago, where we merged two companies right around the time of this conference last year. Blue Source, which had been around since 2001, and Element Markets, which had been around since right around that same time frame. So a lot of history in the space, not a lot of history with the name. But despite, I would say there's a lot more uncertainty that's contributing to that headwind this year than there was last year. And so I think we're just seeing more and more of that paralysis. That's probably the biggest change. So. Sorry, that was a little long-winded.
Not at all.
No, that was great. And you said much of what I was planning to say, so thank you. I can just say what Kevin said. Hi, everyone. Alexia Kelly. I am the Managing Director at the High Tide Foundation of the Carbon Policy and Markets Initiative, which is a new initiative in a family office focused on climate finance mobilization and sorting out the alphabet soup so that we can really start driving action. And I completely agree that the table stakes have changed significantly. My prior role, as I mentioned earlier, was working at Netflix as their Director of Net Zero Plus Nature. And we, prior to 2019, the company had no sustainability program whatsoever and had never even done a greenhouse gas footprint. And it was actually investor advocacy and just a general recognition that large corporations are now expected to have a sustainability function and to be taking it much more seriously. So historically, sustainability offices were often housed in marketing and spent all of their time reporting on the very little action that they were taking in very pretty glossy reports. And I think that has really changed quite fundamentally, in no small part thanks to the expectations set by the Science Based Targets Initiative, and I think also just the overwhelming recognition of the urgency of the challenge. Nobody can pretend like climate change isn't real anymore because everyone sees it every day. And it's really starting to manifest in very serious and incredibly disruptive ways across business operations and supply chains. And so companies, I think, are much more focused now on really taking it seriously. We are still, well behind where we need to be in terms of mobilizing action and resources, but what's changed in the last 12 months, like a $1.8 billion acquisition by a company who is managing timberland for carbon and timber would have been unfathomable, even 3 years ago. And so I think it marks a real sea change that the capital markets are starting to pay attention to this emerging asset class, that they're interested in understanding it. And, we are in a moment of uncertainty because of this question around the claims. So there are billions with a B of, money that is waiting to be deployed once we clarify the rules around how that money is going to be deployed through the existing standard setting bodies. And so as that process works itself out in the next couple of years, I anticipate that, that will really lead to catalytic action by a lot of these companies that are currently just hunkered down and trying to weather the storm. So I'm quite optimistic that we will get through this. The carbon market, I feel like we're sort of surfing, right? It's like waves. Like a year ago, we were at the top of the wave, and now we're like down in the trough, and it's going to take us a little bit more time to get back up on that next wave, but the waves are getting bigger and bigger, and the net impact is getting so much larger than it ever was. So with that, I'll hand it over to Philippe to provide the institutional investor perspective.
Thanks, Alexia. My name is Philippe Crete. I represent Fondaction, which is a Quebec pension plan, investing the savings of about 300,000 workers in the province into sustainable investing. We've been in business for 25 years, and our mission is clear. We invest to make society greener and more equitable. And we do that by trying to stimulate innovation in capital markets and bringing capital to where it's most needed. As part of my job, I'm very privileged to be tasked to develop new investment funds that are impact-driven and oversee their performance. And over the last couple of years, we launched our first carbon fund, which is called Atlantis, which has been essentially an investment vehicle operating in the North American space, primarily catering for large emitters and project developers in the WCI, but recently expanding into the voluntary market. I also oversee another fund that's called URAPI, which is also exposed to carbon pricing, essentially investing in sustainable commodity production in Latin America. I've been involved in carbon markets in different capacities for most of my career, including 8 years at the UN RED program, helping countries building their readiness framework to access RED Plus capital. So in terms of what I see as a tailwind for the market and climate financing in general, I guess I'll echo what Kevin was saying. We've never seen so much commitment by large corporations, either aligning their targets to SBTI or to net zero. Carbon markets last year alone represented $900 billion in trades. The voluntary market over the last 2 years has grown 10-fold, 20-fold, who knows? But it's grown very rapidly. I've never seen so many people at these events. So, it's very encouraging. And that's driving innovation. We're seeing new technologies that, can really make a difference in achieving the Paris agreements. Taking up speed. We see DAC technologies coming into the market. We see trades happening resulting from Article 6, things we never thought would see the light, but it's happening now. So there's a lot of reasons to be optimistic. Yet at the same time, representing a financial institution, we can't ignore what's happening in capital markets at the moment. And that hasn't been really talked about during this conference, but over the last 2 weeks, 4 banks went belly up. The S&P 500 last year lost close to 20% of its value. Interest rates are going up, and we don't know when a recession will hit, but it's likely that it will. And it reminds me a lot of the situation that some of you might have experienced with carbon markets back in 2008 with the global recession, and also I guess, the pre-planned death or explosion of the CDM market in 2012, where a lot of the big banks and large capital providers that were supposed to drive innovation in the market just left. So I'm hoping that it's not going to be the case in the next 12 to 14 months, but it's certainly a reason of concern for institutions like us, and also we know among our peers who have been looking at this market for some times, trying to find an angle to come in, but when they're seeing market conditions like this, they might be a little hesitant to come in. So I see that as a major headwind for the next couple of months. And what has changed? Obviously the macroeconomic conditions, but also where did all the crypto guys go?
I'm not sure I missed those folks, but yeah, it is really worth, I think, reflecting, and I think this will come up through the course of this discussion on the sort of status of the financial system and the banking system in particular. And here in California, it wasn't just sort of an agnostic sweep of certain capital. It was a very specific subsector of lender and service provider in the innovation economy. Folks who were prepared to go the extra mile to understand a business model and promote a social objective, which is sort of the mandate of a more regionally focused bank, and it's exactly that portion of the debt capital provision that is in the dock right now. The tier one banks are okay, but they weren't really doing those deals anyway. So it is part of the new macroeconomic reality that probably will be with us for quite some time. But Alexia, I wanted to come back to something that you said this morning and that you actually got a round of applause for, so that was to be commended, that there's so much sort of abstraction in this space right now, and I know it's because the standards are evolving and we're moving towards something that is more sort of regulatory in nature, and things will solidify at that point, but that has the effect of not just sort of stiff-arming corporates who want to do something on sustainability, but this place feels messier than maybe I'll just put solar on my roof, right? But it also has the same effect on capital providers. They are going to inevitably not burn the brain cells if there's something adjacent, and now there's tons of federal money coming for tax credits. It's just easier and cleaner. So one way through that, I think, is to talk about specific transactions or strategies at the ground level that are working, that are raising money, deploying physical assets or practice changes, and those produce carbon credits that are then transacted. So I think for all of you, what are those actual sort of proof points on the ground, not at the level of standards and wonkery and alphabet soup, but if you wanted to convince a new investor, what would you point to at the asset level that you think would be most compelling?
Oh, well, I mean, these guys are the ones that are actually raising and deploying money. I think I can provide a couple of examples from deals that we did in my last role. One, capital scarcity is still a huge problem in this market, in particular for just project finance and asset finance generally. It's been an endemic problem in the carbon market since the very beginning. And I think given carbon prices and their volatility and the elasticity of the demand, because we're in a voluntary market exclusively at this point, for a lot of folks, it makes it really difficult to sort of mobilize and invest capital with confidence in this space. So my hat is off to those brave capital managers who are doing it and making it work and delivering returns to their investors that are quite respectable. So it can certainly be done. But I think we have time. So one of the things that we did a couple of things to help address this. The first is that with developers that we knew and trusted and had a really excellent track record, we would prepay for credits. That prepayment was often used to actually finance the restoration activities specifically. I like that as a buyer because it means that what I'm investing in is 100% additional. I know for a fact that that project was not going to happen if I didn't write that check. And as a result, we have a new mangrove forest in part of India. Like that is the power of these markets, but that also means that I'm now wearing a whole bunch of that risk should that project underperform, if the dealer decides, the developer decides that they want to disappear, which also happened to us. So I think there's, finding the risk mitigants for corporates and getting them to deploy this capital with confidence is going to be particularly important on the buy side. And then having that long-term offtake agreement as a buyer. So what I want as a buyer is I want a fixed and predictable supply of high-quality credits at a price that I know. So I got asked all the time to sign floating price deals for forward purchase against this or that index. And that did not work for me because I have no idea what the carbon price is, and if I'm only going to be transacting over the counter, I'll just transact over the counter and not wear any of the underperformance or delivery risk or any of the other things that go along with getting into bed with a developer for a long period of time on some of these deals. So I think that that'll be interesting to see how that kind of plays out, because I found plenty of developers who were very happy to agree to a fixed price escalator and a floor price over a certain period of time, so that you're catching some of that upside, but you also have all the downside protection in the event that the pricing really dramatically changes. So Dan, I don't know if that was what you were hoping to hear, but
Yeah.
and Kevin and Philippe both.
Please.
I would love to hear your views on that as well.
Sure, you mentioned the importance of having long-term offtakes for this market, and when we see it as an institutional investor and we talk with other institutions like us who are still hesitant to go in the market, I think there's a misconception or a real perception that these markets are still very volatile. And for pension funds who invest in the long run in planning the retirement of their members, being exposed to very volatile market is not something that is very appealing. And until buyers show stronger commitment in making offtake agreements work for developers and projects, it's going to be difficult to mobilize a lot of the large, sort of more patient and perhaps more prudent capital into this space. But Kevin, Dan, you ask, what strategies also work. We're invested in different types of asset classes that are exposed to carbon, but what we feel as a pension fund works sometimes a bit better is when carbon is one of the cash flows that a given project and infrastructure produces, and that you're not entirely exposed to that market when you make that investment. Renewable energy is an example, at least what's happened under the CDM a decade or so ago. But we're seeing the uptake in capital flow for LCFS projects, particularly renewable natural gas in the United States, and that's coming into Canada too. Those are the types of projects that will attract larger capital and more patient capital like ours.
Can I go?
Please.
All right. Those are great examples. I think what I would answer that by starting off with a high-level concept about how I think capital moves, and then I'll give you some on-the-ground examples, since that was what you asked for. I think it is extremely difficult to push capital into something, but that it naturally can be pulled in. And let me explain what I mean by that. So the IPCC has been telling us for decades about this looming crisis. So why hasn't capital flowed? Why haven't we seen the trillions that are said to be needed to tackle this problem tackle it? Because we're trying to push capital into it. We're trying to say, hey, this is a need, capital, you need to show up, and address this need. When you show capital the economics, when you make the economics clear, it flows. You can just pull it right in. Capital just follows the economics. And so when you can make that clear, you can make a very clear economic case for something, you're speaking the language of capital. And it's very important that it has these, that it serves its purpose, that it has these climate benefits, these social benefits, whatever the thesis of that capital is. But when you show it the economics, it'll flow. And so compliance markets are a great example of doing that. When you look at California's compliance market, you know that the program is there through 2030. You know what certain limitations on the market are that have a theoretical demand component that goes with them. And you believe in the policy landscape that some things will change, but not enough is going to change to risk your investment. And so you can show that to capital, to financiers, and they get it. They get it very quickly. And I guarantee we would not have been able to do some of the things that we've done without some of those longer-term signals. It's harder to get some of those signals from the voluntary market. But we do have some corporates that have stepped up in the last few years to make these very, very long-term commitments. And that, again, you're showing the capital the economics. You can pull it right in. So that's a philosophy that I believe in. And so I think if we want more capital to flow, we need to make that economic picture really clear. And we need to remove as much uncertainty as we can, because uncertainty is the enemy of investment.
Specific examples?
Well, we raised $1.8 billion within the last 6 months, and we did it. We did it when Europe was having its largest war since World War II, and we did it when interest rates moved up 4%, and we did it in an environment where there was plenty of uncertainty. So what we were able to do, one, raising and deploying are very different things. They're both really, really hard. Oftentimes you're trying to raise it first, and then you figure out where you're going to deploy it. We had the advantage of knowing exactly where we wanted to deploy this. We had a very specific opportunity in mind, and that helped with the raise. So that was either luck or call it what you will, but that was a nice thing that made that possible. But we were able to look at compliance markets. We were able to look at history of voluntary markets, not just within the last year, but over the last 15 years that we've been doing this. And fundamentally, what we really wanted to do was show how an industry could change. We wanted to show how the timber industry could change. And this is after 15 years of helping landowners manage their lands in different ways, but we fundamentally wanted to see different change, and we believed that there was an economic value proposition in completely flipping on its head that traditional timber model of harvesting trees. And we were able to bring others along in that viewpoint, but we made the economics very clear.
So I want to probe a little bit the types of capital that are in and around carbon solutions for climate finance. It's often, particularly for like an entrepreneur or project developer, when they're just sort of entering a sector, it's just money, right? But there's actually very different colors of money and expectations and willingness to address risk. And we certainly saw this in California, and I worked in venture for a while, where you had an institutional that thought they were getting into something that turned out to be very different than what they were sold. And not only was it bad for the individual deal, they and their peer group would pull back from that sector because they got burned. So like a special situations group at a pension being asked to take venture risk when they've got other ways to make that return in a much sort of lower risk environment. Not only is that a bad sell from a fundraising perspective, but it actually slows progress for capital formation over time. So my understanding of how the capital has worked in this space is that there was more patient money early. I think, Alexia, you mentioned this, and then it sort of got burned through and didn't return. And so now we're in more of like a venture risk kind of environment. And I wonder if the returns are there, or if we're maybe setting ourselves up for disappointment, as clean tech has disappointed its venture limited partners for a long time. So just talk a little bit about where the money's coming from in the background and what it's looking for, and whether we're channeling it to the right sorts of projects to keep that flowing over time.
I mean, my sense is that we've had this massive infusion of venture and intermediary kind of capital in the last 24 to 36 months into this space at, unprecedented levels. I don't think we've ever seen this volume of cash coming in. A lot of that money, I think, is benchmarking to very high prices on carbon in the future, significantly higher than we've seen to date. So I see numbers thrown around regularly, like $50, $100, $150 a ton out in 2030, 2040. And, who knows? I think most of those forecasts are about as good as the paper they're printed on, to be perfectly honest, because this is not a commodities market in the way that gold is, right? You can't weigh it, you can't feel it, you can't. Very difficult to measure. And so as we move forward, and it's a market created by policy fiat, right? So the reason that we have carbon markets is because we have collectively decided that we're going to value this environmental externality that was not otherwise valued. And so that exercise, is inherently a policy exercise. And so the political risk associated with it is enormously high. And so I think that there is a reasonable possibility that we're going to have some very disappointed and burned investors. The other thing, though, that I think is interesting is that, if you think about offset and mitigation project finance generally as a kind of asset class, whether it's forestry or landfill gas, methane treatment facilities, all of the kind of various instruments that we use to mitigate emissions, they're capital intensive early on, and then often significantly less capital intensive over the course of their lifetime. And so it really does resemble infrastructure finance, which, as we collectively know, Dan, and why the Ibank exists, right? Like, that is not well suited to venture capital and money that's looking for a 10-year return. And so my hope is that we have more people like, Philippe and the work that they're doing, where you're really able to bring in that patient capital that's looking for that lower but steadier return over a much longer period of time. Because, don't need to tell you guys this, right? Like, you look at those yield curves on your carbon accumulation for a lot of restoration projects, and especially if you're doing afforestation, reforestation, or a lot of the carbon removal projects, you're not actually getting into substantial volumes of credit delivery until 20, 30, 40 years out in the future. And I will tell you right now, I don't know a single corporation in existence that is contracting that far out into the future for their voluntary needs. I pushed the envelope hard and we did out 10 years. I don't know anybody else who's going that far out except for maybe the oil and gas majors. And so that, I think there is a real still mismatch in the kind of, the capital needs on the ground with the types of capital that are available right now, given the risk profile and premium associated with investing in the carbon market today.
Yeah, maybe I can bounce back. I think you're right, Dan. At least that's been our experience. Among other institutional investors in the Canadian context, there hasn't been a great lot of interest in investing in carbon markets. I think a lot more interest in climate financing in general for larger infrastructure projects, for deploying, investing in EV companies, infrastructure as well. But the carbon market itself still remain a small market for large institutional capital. There's been some investments made. I think our peers are trying to better understand what's happening in these markets. But overall, I would echo what Alexia said, that most of the capital we've seen flowing has been venture-like, with venture-like returns expectations. We also feel that some investors will be disappointed by the returns because carbon pricing is still quite volatile, particularly on the voluntary market. Not as much in the compliance WCI market, where we've been investing over the last few years. And in terms of bringing more institutional capital, like big capital, into the space, Alexia mentioned the asset class and how it's considered. Frankly, our experience has been that if you want to invest in this space, you have to be creative, because it doesn't fit really in an asset class just yet. And the market is quite diverse. If you are investing in forests and buying the underlying land, well, maybe you're in luck and you'll find investors that understand this particular type of investment because they fit an asset class that they have, which would be, maybe natural resources, or they might put it in their infrastructure bucket. But if you're doing investments that are pure carbon plays, at least for institutions like us, we don't know where to put it. So you have to find a new category and understand the risk-return profile that category would produce, because otherwise you won't be able to manage that investment in the long run. And I'd say the diversity of investment opportunities in carbon markets at the moment make it difficult for big capital to really understand the risk-return profile, because they will vary between different project types, between different sectors tremendously, and you can't just bundle them as like carbon investment opportunities.
Right. Yeah, and I think it's worth distinguishing the venture or the equity sort of return-seeking approach at the company level. Like if you're supporting a platform that has a unique way to address the carbon markets, that's classic venture, and there's good returns. It's capital light versus, we've seen this in climate infrastructure where you run out of bank debt, so you're taking venture capital and putting it into a physical asset. And that's just, the machine might get built, but you're going to have a bunch of really unhappy investors, and they're not going to come back for your next fund. So you made one of one, in the end. So Kevin, what's your take on this kind of color of money question?
Well, I think Alexia and Philippe did a great job. I wouldn't disagree with anything that they said. Our experience has been a little bit different. We have been able to find that very sophisticated institutional investor base in our LPs, that they get the long-term vision of this. They get that we're tackling a mid-century issue. But that it was hard to come by, and there's, I think the types of capital that are really putting a lot of money into the space are that, hit the nail on the head. And so I would consider ourselves very fortunate to have the LPs, have the partners that we do, that really do understand that. But they're hard to come by, and there's still a lot missing. There are a lot of people that are not taking a seat at this table for the reasons that they mentioned.
And Kevin, I don't know if it's worth talking about TPG Rise in particular, right? Who was your biggest investor? But TPG Rise was set up specifically as a growth capital investment fund 5 years ago. But they're looking for ticket sizes in the $10 to $20 million a pop range, and so I think there's actually very few actors in the carbon markets who would be anywhere near being able to absorb the level of capital that you guys could. From an investor like that. But there are not very many TPG Rises out there, and there are not very many companies at the size where you could take and deploy $10 or $20 million efficiently and effectively in this market, and deliver returns back to your original investors at the rates that they're going to want to see. Yeah. So I think we are still in a very nascent and immature sort of capital formation part, and I think that's just part of just where we are. But the sooner that we can get beyond this, the better. And I think the investment, the Inflation Reduction Act, and the infrastructure money that's coming through in the United States, anyways, will have a big impact on helping bump up those prices. Because I'm going to tell you, the $12 a ton is not going to help us substantially change the timber management practices of anybody. Right? Like, it's really, really hard that the timber is just too valuable. But we're having a real conversation with actual TIMOs now, timber investment management organizations, about that trade-off. Like, they're starting to think about, okay, maybe I'm going to make more money farming carbon instead of farming trees. And so that, I think, represents a substantial sea change from where we were even just a short period of time ago.
I want to come back to the role of public funding, because it's obviously hugely significant here in the U.S., and now there's a race in Europe to try and match the incentives to keep those businesses domestic. But let's talk about the transition from this nascent market state predicated on voluntary activity to what are obviously really material commitments coming due from the corporate sector and a governmental interest in transitioning to a regulated mandatory marketplace. Kind of like right now. I mean, we're getting really close to it. So what are you looking for in terms of the sort of structural changes resulting from that transition at the kind of regulatory level, and then the pairing of that with new business practices to deliver carbon that would get us maybe out of, like, if you're going to be in this market, you got to expect 15% annualized return. We're down to like scale money, patient, lower return, but lower risk. Like, how does that transition to the regulated markets play out on the ground, and then capital? So just a small question.
Maybe I can start. Fondaction was set up by the largest workers' union in Quebec, and we have deep ties, obviously, in a lot of communities, but we also work very closely with different levels of government to bring capital where it's most needed, and have been very innovative in the way we do. Blended finance is something we've been doing for many years. Blending public money at lower interest rates with the money of our pensioners. We've launched a social housing program that connect the two dots together to make them work. We've recently launched a energy efficiency transition fund, sponsored by the Infrastructure Bank of Canada. So we're in a space right now where we absolutely need to be creative in the way we use capital and bring value-aligned investors, and that often include governments, to make the economics of new financing vehicles work. And I definitely agree that public money is needed. It doesn't have to be subsidy. It could be a carbon pricing, a strong carbon pricing signal. It could be carbon markets, but also investments. For early stage ventures, for new ideas is crucial.
I can go. I'll give it a go. Thanks for volunteering to go first. It gave me time to think of an answer. I would answer this as much as what I think government will do and what it won't do, what we're not relying on it for. It has the ability to create some certainty, so that's good. Some clarity of the rules, clarity around reporting, clarity around meeting goals, and that'll be excellent for capital flow. And using the IRA as an example of that, since the IRA, capital is just moving. This goes back to the point I was making earlier about pulling capital in. Like when you make those economics clear, the investment decisions that have already been made and the capital that's been committed in a very short time since that was passed is really emblematic or illustrative of this issue. And so I do think that government can come in, provide some certainty, provide some clarity around economic signals, but here's the second part. Here's what it's not going to do. It's not going to help us with our financial infrastructure problem. And Philippe made a comment a little bit ago that he was saying people don't know where to put this stuff. They don't know where to house these kinds of investments, and that is a very real problem. And so you can hear top leadership. You can hear Larry Fink and Jamie Dimon saying what their organizations need to become and where they need to be putting capital. But when you get into the cogs of the financial machine, when you're really talking about the people that are having to underwrite these and block out and separate these investments in their portfolio, it's extremely difficult. People just don't know how to do it. They don't know how to underwrite climate risk. They don't know how to categorize it. They don't know who should be working on it, and it's just very, very hard to effectuate that deployment of capital. And it's a real challenge because what they do know how to do really well is risk an oil field, because they've been doing it for 150 years. They know exactly where that fits. They know exactly who to go to, and they understand the economics and everything that could go right and could go wrong. And that knowledge just doesn't exist. We just don't have that human infrastructure in our financial system yet to really tackle this climate crisis. So that's yet to be solved.
Yeah, and just to complement, I think, both of those perspectives, blended finance is going to be really critical, particularly for the next decade, as is benefit stacking. So in the nature-based, restoration space in particular, the funds that I've identified that are doing, managing to deliver market returns to their investors are doing so because they're layering a variety of things that are making the management practice change or the project overall work. And that includes conservation easements, that includes grants from a variety of government sources for watershed restoration activities, for wildfire mitigation and forest clearing. And so I think there's a couple of small actors, EcoTrust Forest Management being one of them, that have kind of cracked the code on how you do this right. But they're all quite small, and nobody's operating at scale yet. And so figuring out how you can quickly and efficiently get money from where it is now, which is, for the first time in the history of the environmental movement in the United States, our problem is not having enough money. It's how do we get the money we have from the federal government into the places we need it to be going the most quickly. And that intermediary infrastructure does not exist. And, in part because of the problem that Philippe was talking about in terms of not being able to classify capital, but also because we just, the existing capital markets don't really know how to deal with concessionary money. It's not, and they don't understand how to think about the leveraging of concessionary money alongside their market rate capital, that's managed in a very specific way around a very specific set of risk parameters that are all priced and evaluated and, sort of bucketed neatly. And so that mashup that's going to need to happen in the next decade really needs to happen a lot faster. And I think that is the place where organizations like Ibank, and I'm on the board of a nonprofit, CDFI, they're all just tiny. And so we have to figure out how to scale those so that they are comfortable lending to project developers who are doing these projects that are going to be paid for, on the back of a future revenue stream from carbon and other assets.
Yeah, I absolutely agree. And I think the edge of the public engagement is really developing deals, actually originating deals, and sort of blocking out which forms of capital best close it out, including, we'll take a piece as a public lender. We'll do the early spade work to get it set, but then we've got a consortium of public, private, and impact lenders that'll round it out with us. The second largest portion of the Inflation Reduction Act is the National Green Bank. It's 5 pages of legislation, $27 billion, with the intent of capitalizing state and local green lenders to do that more development finance work. It's not investment banking, certainly not commercial banking. It's what's the social objective? How do we stack a little bit of public money if it's to unlock a carbon market or to unlock a ZEV infrastructure play? So I think that's a nice segue, I think, to what to watch out for from this flood of public capital coming down, certainly in the U.S. and I think in the EU as well. I said I would give enough time for questions. I think I failed to do that, but I would love to open it up to folks who have things on their mind. Yes, right here in the front.
I was wondering what you think the role of philanthropy is or could be going forward.
Well, so I'm 1 month on the job, but my observation is that the philanthropic sector has a ways to go in really thinking about how to deploy grant capital in particular, but also, other forms of concessionary capital much more effectively. And, Dan was at the Energy Foundation for a long time, so I'm sure you have views on this as well that would be great to hear. But I think that philanthropic capital can play an enormously catalytic role in helping to buy down some of this risk to get the early movers, moving more quickly and at larger scale. But they need to get a lot smarter about how they're doing that.
Yeah, just really fast. There's been an emerging thesis in philanthropy around markets as something that philanthropy should embrace or at least shape for social outcomes. And I think that's part of the reason we have this green bank movement around the world now is because philanthropy picked up on that. But the transition from grant making to impact dollars, expecting a return, but being prepared to be smart but sub-market on your rates, that's still very nascent, but hugely significant. And just at the top level, there's more and more climate philanthropy dollars, I'm sure you've seen, just trying to find something useful to do. So it's certainly worth keeping our eyes on. Other questions, comments on the finance front? Yeah, right here.
It sounds like you guys are saying as long as the right strategy is to avoid pure play carbon sort of companies, right? Have the timber, have the whatever, and then carbon is a reticent way to maybe bridge the gap between VC and maybe the project finance, or prepayments, I suppose. In case of Netflix, is that kind of what you're saying?
I don't fully share that view. I think that some pure carbon plays are just fine, and actually the more pure carbon play it is, the more clear of an additionality case there is as well, and that's something that resonates with a lot of buyers. But I don't mean to say that. I don't mean to equate the two and say that that's the only way you can have additionalities by having a pure carbon play, and it doesn't. You're absolutely right in that it does inherently make it riskier, right? Because we all know these markets are risky, and so if you got that pure carbon play, then the likelihood of success of that project is beholden entirely to that market. So I don't know that there's a yes or a no answer to that question, but I certainly don't shy away. Our company does not shy away from pure carbon play investments. We have a ton of those. And in those instances, the stronger the market signal, the better. And that can come from a single corporate buyer who says, "I'm in," and I'll be that demand side for this project, or it can come from a compliance market signal, or it can come from the belief in the voluntary market. We've underwritten a ton of investments on that. And so, yeah, neither here nor there, but I hope it was at least helpful.
No, go ahead.
If I may ask, I think it really depends on what type of capital you wish to attract ultimately, because currently, I think, larger capital pools will see carbon markets still as volatile. So in order to reduce that risk-return profile, or to have a risk-return profile that fit a bit better in some of the categories they can underwrite and manage, they might prefer to have a lower risk profile for a lower return. And that could include having different revenue streams bundled with carbon. But venture-like capital provider might be interested in pure carbon play investments.
Yeah, and my point more broadly was just around, I think there's still a mismatch between kind of where the market is pricing and the true marginal abatement costs. But those marginal abatement costs vary dramatically across geographies, across project types, even across markets. So my value of trees in the West is very different than my value of trees in the Southeast. And so the carbon price that I'm going to need to see to materially move management decisions on those forests is dramatically different, right? It's like 2x what it would need to be in the Southeast and the West. And so that, I think, really understanding the underlying commodities markets that you're playing in and or trying to change with pricing of this additional externality is incredibly important, and also not super straightforward, right? Like, it's not easy to go out and kind of piece together, okay, how and that's why financial additionality is so incredibly difficult, to actually implement in the real world, because everybody's hurdle rate is different, everybody's investment, risk profile is different, and so making blanket and generic statements about, well, this project cost less, therefore it's less additional, just doesn't make sense. So the stacking for now, at least in the US, is really about just getting that kind of net return up to where it needs to be in order to really start making some of those decisions and trade-offs across your marginal abatement cost curves, which I'm still a fan of. Nobody talks about them anymore, but
They're hugely important. No, nobody does talk about them.
No.
But that is where the rubber hits the road.
Totally. Yeah.
Maybe just a twist on that answer from the sort of lender's perspective, the super boring bottoms-up debt service coverage ratio perspective. If you're thinking about a capital stack and you've got something in the revenue picture that can service the loan and it doesn't have carbon voluntary market volatility, it's just like a PPA or someone's buying your wood products or whatever it is, then that's the lender's view. The lender likes those economics, but then the equity upside is available to your equity participant, and maybe there's some mezzanine lender in there, but just kind of get the mindset of the particular slice of capital that you're dealing with, and it feels like a more robust picture, frankly, when you've got those layers built into your business strategy.
I'm curious though, like, how many people are accessing debt markets right now for project finance?
Yeah.
Anybody in the room?
I'm right next to you.
But that's really telling,
Yeah.
Yeah, that's a good question. Others? Can't not see this entire half of the room, so. Okay, go ahead.
Is that Nico? Hi, Jason.
Hey, Jason. Can I start?
Please.
Okay. I actually think financial additionality is incredibly important and is inherent in all of the programs that you just mentioned, Jason. It's just assessed in a different way. And I think when Alexia was talking about it a moment ago, or maybe what you were referring to is how you actually assess it. And if you're doing the problems inherent in doing that on a case-by-case basis and providing general rules, say, about hurdle rates when they are so different depending on the risks of each unique project and each investor. That's very, very difficult. So I think what California has done to assess financial additionality is this performance standard approach by saying, just looking at the penetration rate of certain technologies or certain practices. And when you can see clearly that something has an incredibly low adoption rate, then it's not a far leap to say that type of activity is in need of further subsidization, hence the carbon markets, hence the importance of that in making those decisions. But instead of trying to evaluate each project on a case-by-case basis, you're making that generalization across an industry or across a practice. So I don't think that's saying that financial additionality is not important. I think it's absolutely key. It's just a different way to assess it. I think it's a better way to assess it, to be clear.
And I expect that we'll see a combination of approaches in emerging guidance around additionality. So this question is far from settled.
Okay, I think we have time for one last question, and I will. Oh, is there one back there? Yeah, please.
Is that you, Nico?
Three letters that I've been surprised not to hear at the conference so far are ESG. And I was wondering, with Biden's veto on Monday, the bill that was part of this ESG global capitalism movement, and some folks suggesting that BlackRock is
Wow, that is a rich one. You guys, please go first. I could go on all day.
See you guys looking at me.
want
And it's a very valid question. For us, it is tremendously important. All our investments go through diligent ESG screening. Even if they do provide climate benefit, we assess negative impact, but also seek to achieve other positive impacts beyond climate. We are working and investing in Europe or managing investments by European investors who are increasingly looking at these questions with a legislative lens. Some of you might be aware of the recent regulation adopted by the EU on green financing and what can be labeled as green fund with the SFDR 9 provision. So we are already in some of our products starting to understand and have to meet those requirements for various products that we do. So it's a very good point. I mean, perhaps out there some people that think that just doing climate investment is good enough without looking at potential ESG risks or other benefits that are triggered by climate investments. But ultimately, we think that the financial sector is going to be regulated increasingly as to what can be called a green or a climate investment, and they will have to include strong, robust ESG provisions.
I just don't even think the markets are touching right now, Nico. Like the ESG aligned investment world is, we did a round of pension funds and investment retirement fund managers, right? So looking for ESG and climate aligned investment opportunities, and let's just say it's underwhelming what's out there. Like those guys are not actually moving money into any of the stuff we're doing over here. We're just so small and so separated from the publicly traded companies and funds and markets that I actually don't think it will matter that much, because BlackRock is not investing in carbon markets right now. I mean, they just aren't. I don't know, Dan, if you have a different view on the infrastructure side, but that's all making money now, so.
Well, right. I mean, there's a question of whether ESG is an actual definable category of funds that you could measure performance against. It's probably worth picking it apart a little bit, and if you want to focus on E, that's got a little bit more tactility to it, which doesn't say the others don't matter, but I've been an advocate for pulling those themes apart a little bit more and getting a little more specific. But at the top, I think it's just an indication of, if it didn't matter to the other side, they wouldn't be mounting these campaigns to push back against it. So something is working in our favor, and therefore the particularly fossil capital allocation community feels threatened. And so the standard response is to do what they're doing politically. So it's part of the maturation. I think it's a sign of success for climate finance generally. But with how it fits with carbon, I think is a good point. All right. I think we were right on time. Thanks to my panel. Great work, everybody. And thank you all.